In 2023, the U.S. Federal Reserve reported something unprecedented, a loss of over $100 billion. A central bank, the institution that prints money, was losing money. How can a machine that creates dollars run a deficit? The official answer was technical: higher interest rates, lower bond values, the temporary accounting issue. But beneath that language was a different story, one about who absorbs those losses when the central bank's books turn red. Because in the end, the Fed has no shareholders in the usual sense. Its profits and its losses flow somewhere else. Imagine a drain that runs back into the same pool. When the Fed earns interest on its bonds, it sends the profits to the U.S. Treasury, a quiet refund to the government. For decades, that flow was steady and invisible. It helped finance budgets without tax hikes, as if money were recycling itself. But when the Fed loses, the stream reverses. The drain pulls money away from the Treasury and into a hole that no one has to fill, for now. And that's the key, for now. Those losses don't disappear. They accumulate as a promise to pay them back later if profits return. In the meantime, the government collects nothing from its own bank. A hidden tax appears, not on paper, but in time. Every dollar the Fed doesn't send to the Treasury is a dollar the government must borrow instead. What does that mean? It means the losses of a central bank become the debts of a nation. The Fed's balance sheet may be independent, but its losses flow through the same veins as the taxpayer. The numbers are huge, the mechanism subtle, the impact slow, yet relentless. Behind every policy statement and interest rate decision lies a simple paradox. The institution that creates money can also erase it, and someone always pays. The story of the Fed's losses doesn't begin with a spreadsheet in 2023. It begins more than a century earlier, in 1913, when the United States created a central bank designed to be both private and public, both banker and government servant. From the start, it was a hybrid creature, owned by private banks, governed by public mandate. Its task was to stabilize credit and protect the value of the dollar. But its true power came later, when stability began to mean managing the economy itself. After World War II, the U.S. emerged as the financial anchor of the world. The dollar replaced gold as the global measure of value. Every central bank held it, every trade invoice used it. And the Federal Reserve, the quiet engine behind that dollar, became the center of a new kind of empire. Its tools were not armies, but interest rates, liquidity, and trust. Yet trust, like any currency, can be overissued. In the 1980s and 1990s, the Fed built its credibility on consistency. Paul Volcker crushed inflation with brutal rates. Alan Greenspan soothed crises with liquidity. The formula seemed perfect: raise rates to cool, cut rates to heal. Each decision rippled through mortgages, stock prices, and governments abroad. But few ask what happened when the Fed itself became the biggest borrower in its own system. That transformation began quietly after 2008. To rescue the banking system, the Fed created dollars electronically and bought trillions in bonds, U.S. Treasuries, and mortgage securities. It was called quantitative easing. In practice, the Fed became the largest holder of U.S. debt. It paid interest to banks that held reserves and earned interest from the securities it owned. The profits were real, and they flowed straight to the Treasury. For a decade, that cycle looked flawless. Money made money. Then the cycle turned. In 2022, inflation surged to levels unseen in 40 years. The Fed raised rates faster than at any time since Volcker's era. Bond prices plunged. The market value of the Fed's vast portfolio fell by over $1 trillion on paper. For a commercial bank, that would mean insolvency. For a central bank, it meant a new accounting term: deferred asset. In plain English, a pile of losses postponed into the future. The scale was breathtaking. For the first time in modern history, the Fed stopped sending profits to the Treasury. Instead, it began recording losses, tens of billions each quarter. And yet the public heard almost nothing. There was no emergency meeting of Congress, no panic in the headlines, because the mechanism of loss was invisible. It didn't leave the building, it only changed direction. Some economists called it a non-event. After all, the Fed can't go bankrupt in the traditional sense. It prints the currency it owes. But others saw a deeper shift, a signal that the post-2008 monetary model had reached its limit. When the cost of money itself becomes the source of loss, the system starts feeding on its own power. And now we return to the central question. If the Fed loses money and the government earns less because of it, who ultimately pays the difference? The answer, as always, hides in the mechanism. The problem revealed itself slowly, like a shadow under the surface of a calm lake. At first it seemed harmless, interest rates rising, inflation cooling, the Fed normalizing policy after years of easy money. But beneath that technical language was a structural break, one that turned the central bank's own logic inside out. When the Fed raised rates in 2022, it did so to fight inflation. Higher rates make borrowing more expensive, slowing demand and cooling prices. That was the visible goal. Yet in the process, the Fed began paying those higher rates on the reserves held by commercial banks, the same dollars it had created during the era of cheap money. In other words, it started paying more on what it owed while earning the same on what it owned. Its balance sheet inverted. Imagine a household that locked in long-term bonds paying 2%, but suddenly had to pay 5% on its short-term debts. The math is brutal. Every percentage point meant billions in new costs. By 2023, the Fed was paying banks over $200 billion a year in interest, simply to keep reserves parked. And the bonds it held, bought at low yields, weren't paying enough to cover that. The result? A net loss. For decades, the Fed's profits were a silent asset for the government. They reduced the deficit without debate. But once those profits vanished, the Treasury had to borrow more to fill the gap. No one saw a new line item in the budget, yet the cost was real. Each missing dollar from the Fed was replaced by a borrowed one, paid with future interest from taxpayers. A hidden deficit, created not by Congress, but by monetary design. The event was unprecedented. Central banks in Europe, Japan, and the UK faced similar fates. Their large bond portfolios, once considered safe, had turned into traps. When rates rise, bond prices fall. But when a central bank holds trillions of them, the paper losses become continental in scale. In total, global central banks lost over $1 trillion on their assets within a year. It was the silent cost of the decade-long experiment with near-zero rates. And yet, the official stance was calm. No problem, these are accounting losses. Technically true, but economically incomplete. Because even if the Fed doesn't go bankrupt, the ecosystem around it feels the strain. Banks earn windfalls on reserves. The government collects less revenue. And markets, sensing instability, begin to reprice everything, from mortgage rates to the cost of capital. The losses ripple outward, invisible but cumulative. There's an irony here. The very tool meant to stabilize the economy, interest rate policy, destabilized its own source of strength. The Fed raised rates to slow inflation, but in doing so, it weakened the financial position of the state that depends on it. The system began consuming itself. What happens when the guardian of money becomes its own debtor? That question, until recently theoretical, is now tangible. The problem is not just the loss. It's that no one is clearly responsible for it. Not Congress, not the banks, not the Fed itself. And yet, someone always pays. To understand how the Fed's losses actually work, we have to trace the circuitry of money itself. Quiet, technical, almost invisible. Because the Fed doesn't lose money the way a business does. It doesn't face bankruptcy or liquidation. Its losses are mechanical, written into the accounting code of modern finance. Here's how it starts. When the Fed buys government bonds, it pays for them by creating reserves, electronic dollars deposited in commercial banks' accounts at the Fed. Those reserves are liabilities for the Fed and assets for the banks. The bonds, in turn, become the Fed's assets. As long as the bonds yield more than the Fed pays in interest on reserves, the central bank earns a profit. That profit, after covering expenses, is transferred to the Treasury, like a dividend from the nation's money printer. But when the Fed raises rates sharply, the math flips. The bonds it bought earlier keep paying low fixed interest, say 2%, while the reserves it owes to banks now require 5%. Instantly, the spread turns negative. Every passing day, The Fed pays out more than it earns. The losses compound, quietly, like water rising behind a dam. In ordinary accounting, such a situation would erode capital, leading eventually to insolvency. But central banks live in a different reality. They don't mark down their capital to zero. Instead, they record a deferred asset. It's a promise that future profits will someday offset today's losses. Until then, the deficit simply accumulates as an IOU from the future to the present. This mechanism hides the pain, but doesn't erase it. While the Fed can create money, it cannot create real value out of thin air. Every dollar it spends to pay interest to banks comes from somewhere, from the potential remittances that would have gone to the Treasury, from the deficit that must now grow to replace them. It's not a cash drain from citizens' pockets, but a time-shifted one. Today's losses become tomorrow's debt service. Meanwhile, those receiving the interest, mostly large commercial banks and money market funds, enjoy a stream of risk-free income. It's one of the quietest redistributions in financial history. Public losses turning into private gains, not through corruption, but through the plumbing of monetary policy itself. And the irony deepens. The Fed raises rates to cool the economy, yet in doing so it pumps billions into the financial sector, fueling the very capital that speculates on the effects of those same rate hikes. Money flows in a circle, out through interest payments, back through government borrowing, and into the Fed's books as new securities. A system feeding itself, perfectly logical and perfectly fragile. There's no scandal, no fraud, no villain, just arithmetic. The structure of modern central banking ensures that when inflation rises and rates climb, the guardian of stability must bleed quietly to sustain credibility. The cost is hidden, deferred, and impersonal, but the circuit always closes. Eventually, the losses return to the same origin, the public balance sheet. And that's the mechanism, precise, technical, and unstoppable until trust itself begins to question the math. If this helped you see how the machine actually runs, right where you're watching from. When the losses became official, the tone was restrained. No crisis meetings, no flashing headlines, just a line in a report. The Federal Reserve recorded a deferred asset of $133 billion. Bureaucratic language for something monumental. Because that number in practice means this. The Fed stopped sending money to the Treasury. For the first time in decades, the flow reversed. Instead of the Fed returning tens of billions each year to the government, it began accumulating losses. Losses that will take years, maybe decades, to offset. The U.S. budget didn't collapse, but a quiet hole appeared in its foundation. Until 2022, the Fed was transferring roughly $100 billion a year in profits. Those payments helped shrink the deficit without raising taxes or cutting spending. Now, that stream is gone. The Treasury must borrow more to cover the same expenses. It's not a headline figure, but a hidden cost, absorbed through new debt issuance. And in the long run, debt is never neutral. Every lost dollar of remittance becomes a dollar of new borrowing. Every dollar borrowed accrues future interest. The burden compounds, not immediately, but inevitably. It's like skipping a payment on a loan and calling it temporary. The clock keeps ticking. Meanwhile, banks and money market funds, the recipients of the Fed's interest payments, have become silent beneficiaries. By simply holding reserves, they now earn more than ever before. In 2023, some large institutions received billions in risk-free interest from the Fed. That money, once destined for public use, now circulates in the private sector. No vote approved it, yet it happened automatically through the gears of policy. The political consequences are subtle but profound. Public trust in independent monetary policy relies on the belief that the system works for the public good. But when the central bank pays the largest financial players, while the state borrows to cover its losses, the image of neutrality begins to blur. The redistribution isn't ideological, it's mechanical. Yet perception in economics is as real as capital. Globally, the pattern repeats. In the UK, the Bank of England required direct taxpayer support to cover its own bond losses. In Switzerland, the central bank reported the largest loss in its history, over $130 billion. In Europe, several national banks suspended dividend transfers to their governments. Each case followed the same logic: higher rates, lower bond values, evaporated profits. The era of quote-unquote free money revealed its deferred invoice. There's a second consequence, quieter, more psychological. The illusion of the central bank as an untouchable entity has cracked. For decades, the Fed's balance sheet was a symbol of control. Now it's a reminder that even the issuer of money can't escape the arithmetic of its own design. Losses change nothing in daily operations, yet they change everything in perception. And perception is what sustains the dollar's global role. Some analysts argue that it doesn't matter, that the Fed's losses are bookkeeping artifacts. But every artifact tells a story, and this one says, the monetary engine that fueled global finance now runs on negative equity, by choice, not by accident. A system designed to protect the dollar now quietly erodes its fiscal base. It's a paradox too elegant to ignore, the guardian of value, losing value, and calling it stability. The pattern isn't new, it only changed costume. What we call the Fed's losses today is the same mechanism that decades ago appeared under different names: inflation, devaluation, monetization. Then it happened through the printing press, now it happens through interest. In the 1970s, the US government paid for its ambitions with inflation. Too much money chasing too few goods. Prices rose, debt shrank in real terms, savers paid the price. It was a tax no one voted for. Today, the form has shifted. Instead of printing, the Fed pays. Instead of inflation eating savings, higher rates transfer wealth silently from the public balance sheet to the financial sector. The principle remains: invisible redistribution through monetary design. What used to be called seigniorage, profit from creating money, has inverted. Now it's anti-seigniorage, the cost of maintaining trust in money itself. When the Fed pays banks to hold reserves, it's buying credibility. When it absorbs losses, it's preserving faith in the system. The loss is the price of stability. But stability, like insurance, becomes expensive when risk is systemic. And the paradox deepens. The Fed's balance sheet still holds nearly $7 trillion in securities. If it sells them, prices fall further. If it holds them, losses persist. Either way, it can't exit cleanly, because the exit itself would shake the structure it protects. So the system remains suspended between two poles: high rates to fight inflation and high losses to sustain them. A monetary stalemate dressed as prudence. Globally, other central banks repeat the pattern. The European Central Bank now pays more in interest to banks than it earns on its bonds. The Bank of England's losses are covered by the Treasury, directly from taxpayers. In Japan, the Bank of Japan holds assets worth more than the country's GDP. Each institution faces the same dilemma. To maintain credibility, they must carry losses indefinitely. They've become insurers of the very volatility they created. And then comes the deeper parallel, with history itself. In the 1960s, the U.S. promised that every dollar could be converted into gold at $35 an ounce. By 1971, that promise collapsed. Too many dollars, too little gold. Today, the promise is different, that every dollar of debt can be managed through monetary control. But again, there's a quiet mismatch. Too many claims, too little yield. Then it was called the gold window. Now it's called the balance sheet. The principle is the same: faith backed by a finite capacity for loss. And yet the system persists, because it must. Every dollar in your account, every bond in a pension fund, every mortgage, every tax, all of it rests on the assumption that this circuit of money, debt, and trust will continue to spin. To stop it would be unthinkable. So it continues, adjusted, renamed, rationalized. Losses become deferred assets. Debts become policy tools. And what was once considered a flaw becomes the very foundation of stability. The modern parallel isn't a repetition of the past, it's its echo. The mechanism didn't disappear after 1971, it went underground, resurfacing in digital ledgers instead of gold vaults. History didn't change, only the vocabulary did. and now we live inside the same structure, only written in different code. Losses, in the end, are only numbers, but the story they tell is older than finance itself, a story of belief. Every monetary system, from gold coins to digital reserves, runs not on metal or math, but on confidence that tomorrow will honor today's promise. When that belief falters, even perfect accounting can't hold value together. The Federal Reserve's losses are not the end of stability. They are its reflection, a mirror showing how much we're willing to pay to keep faith intact. Every deferred asset, every unpaid remittance, every quiet interest payment to the banking system is a small piece of the same insurance policy: belief in the dollar. We accept that faith costs money and that sometimes the bill arrives long after the service was rendered. Look closer and you'll see the pattern repeating. In ancient kingdoms, it was gold that vanished. In the 20th century, it was purchasing power. Now, it's balance sheet equity. Different symbols, same story. The center of the system absorbs the pain so the surface can remain calm. It's not corruption, it's architecture. Somewhere in the archives of tomorrow, historians will note this decade as the moment when the Fed, the world's most powerful central bank, learned the true price of stability. Not in dollars, but in trust. Because what the Fed loses in money, it buys in time. And time, in economics, is the most expensive commodity of all. The system hasn't failed. It has matured into paradox, a structure that survives by consuming a little of itself every year. And as long as we keep believing, it works. The moment we stop, it ends. History doesn't repeat, it remembers.